Hello and welcome to this edition of Money in Motion video blog. This is Dan Perkins and thanks for watching. It's been a while since I've done a message for you. I made a promise to you if there wasn't anything important to report that I wouldn't bother you. By now you've received your first quarter statements and I hope you're all pleased with the progress that we made. We finished up pretty well and the portfolios are looking exceptionally well going into mid-April. I want to talk about a couple of things that I think are important that we should be aware of. First, the anticipation is that the gross domestic product, for our country will probably come in somewhere around the first quarter, maybe perhaps even minus 1/10. That means that we made no progress. Our economy is not growing. Now, that concerns me because we're losing momentum in the economy. It concerns me also that markets are going to get nervous about the direction of the economy and therefore the direction of interest rates. Interest rates have an impact on the direction of the economy. We have very low interest rates right now, and yet the accommodative nature of the Fed is not allowing the markets to move significantly higher or for earnings to dramatically expand. There's a thing going on in this world that is that's very disconcerting to me, and that is the number of nations and central banks who have adopted a negative interest rate policy. Japan and Germany and France and many of the European Union nations the central banks have let interest rates go below zero. What does that mean, below zero? It means literally you're going to have to pay the government to buy their bonds, and you're going to have an interest rate that is going to produce a negative return for every year that you hold the bond to maturity. I know that seems highly unlikely, but it's actually true. Right now, the yield on the 10-year Japanese bond is minus 12 basis points annually. Now, our 10-year bond is about 1.7%, 1.7 to 1.75. Similar returns are available in Germany and in France. And so what's happening is that people who want to keep money in the bank or buy government obligations are guaranteed to lose money. Is it possible that the Fed can adopt that policy in the United States? Well, you may remember that last December, before the Fed made their first move and the markets went crazy on the downside, the Feds thought that they were going to do at least 4 more interest rates rise of at least 1/4 point in 2016. They did one. The economy is going nowhere. In fact, it's going south. And now the Fed is talking about maybe taking all the interest rates increases for 2016 off the table. So that if the economy continues to slow, the only alternative for the Fed will be to begin to create negative interest rates. Why do they want to create a negative interest rate? They want to drive people into formation of capital as opposed to the savings of money. Now, it's clear that our government continues to run at a huge deficit and we're large issuers of debt. But the reality is, if you can't get a positive return, you either take the money and home, put it in a coffee can and bury it in the backyard, or put it under your mattress, or you have to take the risk of the stock market to get a positive return. What's really upsetting about this negative interest rate policy is that for now almost 8 years, savers have seen their return on certificates of deposits and money market funds at zero for almost 8 years, no money. And now the idea that we're going to give the government money to buy a certificate of deposit to lose money, or to buy a treasury and lose money, is going to be difficult for a lot of people to swallow in this country, but it could be coming. It's important then, if interest rates are going to turn negative, anything that produces a positive interest rate may in fact be of extreme value to us as investors. For example, preferred stocks, master limited partnerships, all of these that pay much higher dividends will possibly appreciate in value simply because they pay a positive return and an attractive positive return. So I'm looking for a shift in the market, money towards the things that we already own. Preferred stocks, high dividend common stocks, REITs, master limited partnerships, royalty trust. All of these higher income investments will produce positive returns. And speaking of returns, I think we need to talk about that too. I think the expectation when we started working together, whatever it was that I was looking for a return net of fees and expenses on an average annual return over a 5-year period of somewhere between 6 and 8%. I think that has to be adjusted given that the 10-year yield in the United States is 1.7 and cash pays nothing, probably has to be reduced to somewhere between 4 and 6%. Still good returns compared to a 10-year treasury at 1.7 or 0 on cash. But I think that expectations of returns have to come down. Now, the one thing that could possibly reverse that is that if there is a Republican outcome in the presidential election and that the Republicans retain control of both the House and the Senate, I think the market and the economy is very looking forward to a replacement of our president. And I think that a Republican who might be more conservative and more interested in cutting spending and reducing the budget deficit and put more money in the taxpayers' pockets might be well received, to the point that you could see perhaps a very nice year-end rally that could take place. So for right now, dividends are important. They are the king at the moment. We have cash. So I look for opportunities where we can get exceptional returns. I will deploy that cash, but as always, I want to take my time and try and figure out what is the best thing to do. It's nice to see your accounts go up after seeing them go down through the first part of that ugly first quarter. But I think the ugly part is behind us, but the next part is going to be slow and modest returns. Should you have questions, please feel free to give me a call, send me an email, and I'll do my best to try and answer your question. This is Dan Perkins, and thanks for watching.